Strive Inc., trading under the ticker symbol ASST on the Nasdaq, is currently trading at a live intraday price of $16.35, marking a modest gain of about 0.28% in this morning session of Tuesday, May 5, 2026. While the broader market seems to be treading water, the activity we are seeing in ASST is far more calculated than the surface-level numbers suggest. Most investors look at this ticker and see a niche asset management firm with a controversial anti-ESG stance. But the reality is that Strive has effectively morphed into an aggressive Bitcoin acquisition vehicle that is now competing for dominance with some of the largest public holders of digital assets in the world. Just yesterday, the company disclosed a fresh purchase of 444 Bitcoin for nearly $34 million, pushing their total treasury above the 15,000 BTC mark. This is the insight most retail traders are missing. You aren't just buying an asset manager anymore. You are buying a leveraged bet on digital scarcity, wrapped in a corporate structure. The expectation from the general public is that a firm founded on the principle of returning to excellence in corporate governance would focus on traditional stock picking and fee-based revenue. However, the reality is that Strive is now the 9th largest public holder of Bitcoin globally, sitting right alongside heavyweights like Riot Platforms and Coinbase. This shift has created a massive tension in the stock price. We've seen the 52-week range swing wildly from a low of $7.02 to a staggering high of $268, a volatility profile that looks more like a biotech startup than a Schwab Intelligent Portfolios competitor. This extreme price action is a direct result of the company using Bitcoin as its hurdle rate for capital deployment. They aren't just looking for investment help or a way to self-investing. They are actively draining their cash reserves to accumulate an asset they believe will outperform any traditional equity. If you look at the daily trading volume, it remains relatively thin compared to the massive institutional shifts happening behind the scenes. This creates a dangerous trap for those who invest online without understanding the liquidity constraints. While many people use investing sites to track basic PE ratios, those metrics are essentially useless here because Strive is reporting massive GAAP losses, over $390 million in its first 6 months as a public entity, primarily due to non-cash impairment charges on its digital holdings. This is where the curiosity loop tightens. If the company is losing hundreds of millions on paper, why did TD Cowen just initiate coverage with a buy rating and a $26 price target? The answer lies in the Bitcoin yield metric that management is now using to justify their strategy. They claim a yield of over 13% for the first quarter of 2026, which is a clever way of framing their aggressive accumulation as a form of organic growth. The disconnect between expectation and reality is most visible when you compare Strive to traditional platforms like Fidelity or Interactive Brokers. While a Fidelity brokerage account or Robinhood stock trading app focuses on providing a broad array of assets, Strive is narrowing its focus to a singular high-conviction bet. This has made ASST a polarizing figure in the online investing world. On one hand, you have the anti-woke crowd that supported the company's initial mission to move away from ESG-driven mandates. On the other hand, you have institutional analysts who are struggling to value a company that is essentially a closed-end fund for Bitcoin masquerading as a management firm. The recent move to acquire Semler Scientific and its 5,000 BTC was a clear signal that the original asset management business is now secondary to the treasury strategy. When we look at the macroeconomic pressures of 2026, the stakes for Strive become even clearer. With the Reserve Bank of India cutting rates and the U.S. Federal Reserve expected to follow suit with 50 basis points of non-recessionary cuts, the environment for hard assets is becoming increasingly favorable. Lower rates typically weaken the dollar and drive capital into deflationary assets, which plays right into Strive's hands. However, the risk of a reversion to the mean in the asset management sector is real. If the fee-generating side of their business, the part that actually manages Fidelity ETFs or competes for space in an individual brokerage, fails to scale, the company will be entirely dependent on the market price of Bitcoin to sustain its valuation. Recent institutional activity shows a divergence of opinion that is rare for a mid-cap stock. While some analysts are issuing sell ratings based on the lack of profitability and high price-to-sales ratios, we've seen over 50,000 shares of insider buying in the last 3 months. Insiders usually don't buy when they think the ship is sinking. They're seeing something the broader market hasn't priced in yet. Perhaps it's the potential for their healthcare subsidiary, Clinovanta, to be spun off or monetized, providing a fresh injection of capital to buy even more Bitcoin. Or perhaps they believe the intelligent portfolio of the future is one that holds a massive overweight position in digital assets as a hedge against global currency debasement. Comment below how many shares of Strive you currently hold, or let me know if you think using a corporate treasury to buy Bitcoin is a brilliant move or a recipe for disaster. To understand where Strive is going, we have to look at what they actually do on a day-to-day basis.
Founded by Vivek Ramaswamy and now led by CEO Matt Cole, the company's original business model was to offer ETFs that prioritize shareholder value over social agendas. They wanted to provide an alternative for people using Robinhood Investments or SoFi Invest who were tired of seeing their capital used for political purposes. They launched a series of products designed to compete with the likes of BlackRock and State Street. But the pivot to Bitcoin accumulation has fundamentally changed the risk profile. Now when you look at ASST on a trading platform, you have to realize that nearly 95% of their recent GAAP net loss was simply a reflection of the fair market value of their digital holdings. It's a paper loss, but it's a loss that scares away the conservative crowd who prefer the safety of Fidelity Mutual Funds or a SoFi robo-advisor. The expectation was that Strive would be a slow-growth, high-margin fee business. The reality is that it has become a high-growth, high-volatility financial engineering firm. They are raising capital through structured finance products like their SADA preferred stock, which they've used to retire debt and fund further acquisitions. This is a sophisticated game. By issuing preferred shares at a premium and using the proceeds to buy an asset they believe will appreciate faster than the cost of that capital, they are attempting to manufacture shareholder value out of thin air. It's the same playbook used by MicroStrategy, but applied to a company with an active operating business in the asset management and healthcare space. Looking forward, the catalysts for Strive are tied directly to the upcoming halving cycles and the general institutional adoption of digital assets. If we see more firms like Interactive Brokers or Fidelity Wealth Management start to integrate digital assets more deeply into their core offerings, Strive's early mover advantage in the corporate treasury space could lead to a massive re-rating of the stock. However, the risk of regulation remains the elephant in the room. Any government crackdown on corporate digital holdings would be catastrophic for ASST. The company's future outlook is a binary scenario. Either they become the premier institutional vehicle for Bitcoin-backed finance, or they become a cautionary tale of what happens when a management team loses focus on its core product. The tension here is palpable. Every time Bitcoin sees a daily swing, Strive stock follows, often with a multiplier effect. This institutional-grade volatility is why many retail investors are flocking to Robinhood Crypto or SoFi trading platform to get a piece of the action. But the real depth of the story is in the Bitcoin yield metric. Strive is reporting that they are actually increasing the amount of Bitcoin they hold per share, which is their ultimate goal. If they can continue to grow that yield without diluting the common shareholders into oblivion, the expectation of a $26 price target might actually be conservative. In closing, the central insight of the Strive story is that the market is still trying to figure out how to value a hybrid entity. It's not a pure asset manager and it's not a pure Bitcoin proxy. It is something new, a structured finance company that uses its operating business as a baseline to support a massive, aggressive bet on the future of digital currency. The reality of their 15,000 BTC holding has completely overshadowed the expectation of a simple anti-ESG investment firm. Whether you're using Robinhood fractional shares to nibble at the edges or managing a complex individual brokerage account, ASST is a ticker that demands your attention because it represents a total break from traditional corporate finance. The contrast between the paper losses and the aggressive accumulation creates a gap that will eventually have to close. And when it does, the movement will likely be violent. Strive has established itself as an authoritative voice in this new space, and its leadership seems more than willing to double down on their conviction regardless of the short-term market noise. Maintaining this level of authority in a volatile sector isn't easy, but by tying their fate to the most successful digital asset in history, they have ensured that the world will be watching every move they make. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.